Embattled Chinese developer Country Garden said on Monday that its Forest City project in Johor was proceeding as planned and it has sufficient assets, despite concerns about its financial strength amid debt woes, according to a report by Reuters. This comment by China's largest private developer came after it missed $2 coupon payments this month, totaling $22.5 million, fueling fears that the country's property debt crisis could hamper a broader economic recovery and spill overseas. In a statement, Country Garden's Singaporean and Malaysian units said that its company's projects in Malaysia are operating normally and the sales performance is strong, adding that its overall operations in the region was safe and stable. It added that various debt management measures are considered to actively resolve the pressure of periodic liquidity to ensure the company's long-term future development, but did not elaborate. Meanwhile, Bank Negara came out to say that the current development with Country Garden in China is not expected to pose any material impact on the overall property market in Malaysia. The massive Forest City project, built across 4 reclaimed islands in Johor, has been beset by challenges since its 2016 launch and is now home to about 9,000 people, Reuters reports. Demand fell sharply following China's move to stem capital outflows and the COVID-19 pandemic, which prompted fears of a housing glut and environmental damage from the land reclamation. Country Garden's statement came after Prime Minister Datuk Sri Anwar Ibrahim announced last week that the project would be designated a special financial zone to attract investment and help cut the cost of doing business there. Among the new incentives offered are a special income tax rate of 15% for skilled workers and multiple entry visas. Forest City is a JV with Esplanade Danga 88, a private company backed by the Johor State Government and the Sultan of Johor. The project aims to house 700,000 people by 2035 in a development that includes office towers, malls and schools, besides residential buildings. FGV Holdings recorded a net loss of 12.9 million for its second quarter versus a net profit of 374 million a year ago due to lower CPO prices and the impairment loss of its Indonesian plantation assets. This is the plantation giant's first quarterly net loss since the first quarter of FY 2021, when it posted a 35.4 million net loss. Revenue for the quarter also declined by 35% year-on-year from 7.43 billion in the second quarter of FY 2022 to 4.49 billion ringgit. The quarterly loss meant that FGV was in the red for the first half, with a net loss of 805,000 compared with a net profit of 743.3 million in the same period last year. Cumulative revenue declined 32% year-on-year to 9.09 billion ringgit. In a statement, FGV said it expects CPO prices to remain stable in the near future, ranging between 3,800 and 4,000 ringgit per tonne, primarily due to the adjustment of Indonesia's CPO export quotas. CEO Datuk Nazrul Mansor says that the planter will implement key strategic initiatives to mitigate these challenges and enhance productivity, and anticipates continued improvement throughout the year. FGV said it invested approximately 196 million for its ESG initiatives in the first half, including ongoing engagement initiatives with independent auditing firm Elevate and the US Customs and Border Protection to address the suspension of the withhold release order. AirAsia X posted its fourth consecutive quarterly net profit in the second quarter of 5.54 million, a vast improvement to the massive net loss of 652.5 million it posted the year before. Quarterly revenue soared 379% on the back of a surge in international travel as borders reopened and more aircraft were brought back into service. During the quarter under review, the company carried a total of 621,984 passengers, delivering a surge of 70 times year-on-year with a passenger load factor of 76%. Available seat kilometres was recorded 25 times higher year-on-year, standing at 3,509 million, with a recovery rate of 42% against the corresponding period in 2019. Compared with the same period last year, the number of sectors flown increased by over 27 times, from 81 sectors to 2,234 sectors as of June 30th, 2023. Looking ahead Etihad CEO Benyamin Ismail said the group remains on track to have at least 16 aircraft operational by the fourth quarter and is confident that AAX will maximize the positive impact of the market once the peak travel season begins in earnest at year-end. He adds that the airline is also driving its commercial ambitions with new and improved product offerings across all its revenue segments as it works to further enhance its pricing strategy. Sime Darby Property has revised up its sales target for FY 2023 from 2.3 billion to 2.7 billion and its GDV launch target of 3 billion to 4 billion ringgit. It said this in a statement to the boss when announcing that its net profit for the second quarter fell 32% year-on-year to 71.1 million due to a higher share of losses from joint ventures. In contrast, revenue for the quarter actually improved to 688.9 million from 615.6 million a year ago. Sime Prop also declared an interim dividend of 1 cent per share. It was a similar story for the first half, where net profit declined 16% to 131.7 million, despite revenue growing by 26% year-on-year from 1.09 billion to 1.37 billion ringgit. Sime Prop said it had recorded sales totaling 1.5 billion, representing 65% of its previously lower 2.3 billion sales target. It said the industrial segment was the key contributor with 40% of 597 million of total sales achieved in the first half. Group Managing Director Dato' Azmir Merakan said in the face of current market dynamics, the developer strategy is rooted in understanding market nuances and consumer demand. He says this has allowed it to pivot effectively and capitalize on areas of growth while maintaining consistency in its offerings. On the outlook for the rest of the year, Sime Prop says it is confident that the strong momentum it saw in the first half will continue into the second half. Mercury Securities Group, which is slated for listing on the ACE market on September 19th, expects better revenue recognition from the margin financing component of its stockbroking business post its initial public offering. Managing Director Chew Sing Guan based its confidence on the margin financing business's compounded annual growth rate of 36% from FY 2019 to FY 2022. Mercury Securities has allocated 26.86 million from its total targeted IPO proceeds of 39.27 million to expand this part of its business. The proceeds are based on the issuance of 157.09 million shares at an issue price of 25 cents per share. Chew explains that Mercury Securities is using internally generated funds to give out credit facility, but the IPO proceeds will allow it to expand the provision of the margin financing facility to its existing and new stockbroking clients. On the corporate finance segment of the business, Chew said the IPO component is the profitable part at the moment, adding that the group is currently engaged with 8 more companies to assist them on their listing journey. In 2022, Mercury Securities facilitated 5 IPO exercises, of which 1 was for the main market, while 2 were listed on the ACE market and the remaining 2 were on the lead market.